Welcome back, everyone, to the Geeks, Geezers, and Googlization Show, the home of Googlization Nation, where we talk with HR and business thought leaders about the crazy shift going on all around us and explore the disruptive convergence of technology, business, and people. Here are your hosts, Ira Wolfe and Jason Cochran.
Hey, welcome back, everyone, to a very special episode of Geeks, Geezers, Googlization, a show from the People Forward Network. I'm Ira Wolfe. Thank you for being part of Googlization Nation.
And I'm Jason Cochran. If you think this is just another podcast, think again. We are the voice of the most important, crucial conversations that are confronting business leaders and people today. Our goal is to bring you ways to reimagine tomorrow and explore the impact and convergence of business, technology, and people.
Here we are on the 12th day of the new year, 2023, and for anyone who was expecting a magical economic, political, and societal reset, when the ball dropped and the fireworks exploded just a few days ago, it's pretty clear it ain't gonna happen. But why we're here, why we exist, why Jason and I do these shows is to help you make sense of what is without a doubt a very fuzzy, finicky, confusing, and never normal time. So to help us figure this all out, we are very pleased to welcome back three of our favorite business experts. First, we've got Dick Bove, and let me welcome him back onto the stage. There we go. Happy New Year, guys. So
Happy New Year,
everyone. So we've got Dick Bove, who is on your upper right. He's becoming a pretty familiar face these days to Googlization Nation members, and we are so fortunate for him to take some time out and be back with us again. He's a frequent visitor to many of the top business shows, such as CNBC, Bloomberg, racking up over 1,500 interviews. And if you've missed Dick on TV, you might have caught his name somewhere in one of those 10,000 print interviews. Dick's the chief financial strategist at Odeon Capital Group, and is highly sought after thought leader for investors, the media, and even the White House. Next, on the lower right, we've got Dick. Joining Dick is Mat Van Alstyne. Can't talk today. He's co-founder and managing partner of Odeon Capital Group, a leading Wall Street executive. Matt and Dick team up each week on the podcast Odeon Capital Conversations, known for their well-informed outlook and views. Odeon Capital Conversations podcast, which I highly recommend, is now a top-ranked Apple podcast in the business news category in the U.S., Canada, Europe, and Asia. And rounding out our group today is the host and moderator of Odeon Capital Conversations. He's our third guest. Our good friend, John Aidan Byrne. John's an award-winning journalist, multimedia editor, and also host of the popular podcast Dig Life Deep, now ranked in the top 1.5% of all podcasts. Dick's covered Wall Street and Main Street for many years, and he wrote what is now a famous business cover about our business story about Bernie Madoff and his investment firm back in Bernie's heyday. We're going to turn the tables on John today and dig a little deeper in just a few minutes and explore how that might be playing out again with the recent FTX crypto fiasco. And by the way, if you haven't been listening to Dig Life Deep, I hope you'll check it out, because each week I join John for what's become a really popular segment called Future Shock 2.0. So let's get started, gentlemen. I know we got a lot of people waiting to get some advice and try to figure out what's going on. By the way, Happy New Year to everybody.
Happy New Year.
So Dick, first question goes to you. You might at one time have seen the video where a group of people are talking and suddenly this gorilla shows up and walks amongst those people, but no one notices, including the people watching the video. It seems we have a gorilla in the room. We may have a family of gorillas walking amongst us, but we tend to ignore them. And that the gorilla is demographics. On a recent podcast, I believe it was December 20th, on the Odeon Capital Conversations, I'm a demographic stat freak geek. Many of you know that. I've followed that for the last 25 or 30 years. You shared a stat that freaked me out, which is tough to do these days. So according to the United Nations, and this is your quote, in 2050, there will be more people in Nigeria than there will be in England, France, Spain, Germany, and Italy all put together. That's 400 million people in Nigeria alone. We don't often think about that. We worry about China and India, but we don't think about Africa. So question to you is, because this was a real big point that you made, why should we care? And wouldn't that be good for us if there's 400 more people in Nigeria to consume our goods and services?
You're on mute, Dick.
Dick is on mute.
You're still on mute, Dick. And we want to hear what you have to say.
All right, I'm sorry. As I say, I think the problem is that basically in the North Atlantic countries, also in places like Japan and China, the population is basically reaching a point where it's not replacing itself. In other words, again, if you would take the United Nations study, you would see that most of these European nations that you just mentioned are going to show flat to down populations. And if you take a look at the United States, I think by the year 2030, deaths will be higher than births, which means that immigration is absolutely necessary, for this country to grow its population. On the other hand, if you go to Africa, not only is Nigeria explosive in terms of its population growth, but Ethiopia, which is close to next door, is in a similar situation. And if Eritrea and the Tigray province hadn't been breaking away from Ethiopia, they would be up there pretty close to Nigeria in terms of population. If you go down to the Congo, you find that, the births per woman just a couple of decades ago were 9 to 1. It's down to 5 to 1 now, but compare that to the United States where it's 1.6 to 1. So the issue very simply is the countries that have money are not growing their populations. The countries that have a number of economic and political problems are growing their populations. So why should we think that the people who are in those countries where there is a difficulty in surviving won't move to the countries that have the money to support them, just a lack of willingness to see these people move in? And I think it's going to create a conflict. I think the conflict is going to be significant. And just one last note, by 2050, Egypt will have more people than Russia. Will the people in Egypt stay there, or will they move to Russia? So I think we're talking about the likelihood of population movement, and that population movement is going to be destabilizing for many of the European governments, and certainly in the United States at the present time, it's creating a lot of political furor.
So does that create an opportunity for us? That means there's also a lot more consumers out there. But when we look at our current labor shortage, and we're going to talk a little bit about that, whether there are a number of deniers there, but what the impact of that is, we still have a terrible we have no immigration policy at the moment, or if we do, it's somewhat dysfunctional. Of where, does that create an opportunity for us in the future, or what's the balance between threat and opportunity?
Well, I think, it would create an opportunity if the United States was a nation similar to what it was 40, 50, 60 years ago when it was producing. In other words, roughly, at the end of World War II, 1 out of every 3 workers in the United States were involved in production. And if you add to that the people who were moving that production, delivering it into the economy in the United States and worldwide, 1 out of every 2 people in the United States were producing and moving products, globally. That's down to 1 out of every 5 at the present time, and the people in production are 1 out of every 12. So the net effect is, we are not in the position, in my view, to take advantage of the opportunity to, if you will, sell products to these rapidly growing African nations. China, on the other hand, has loaned money to virtually all of them. And it has, huge amounts of debt outstanding to places like Kenya, Djibouti, which is a little country which has a big impact on the Gulf, throughout Africa, the Chinese have put money in, have used this Belt and Road system so that they put factories in. They're exporting their own population to certain of these countries to run those factories. So we're not jumping on this opportunity. We're still in a position of trying to determine whether we want to be a consumption, leader in the world, or whether we're going to go back to be a production leader, which is what we absolutely must do.
And just this morning, and I wish I had more time to go through it. There was just a new report released by the Aspen Institute. And it talked about our economic future in an era of uncertainty. I don't believe that's the exact title, but you get it. And I quickly flipped open, and they talked a lot about what you just shared. In that business, and I wasn't familiar with this term before, but they called it business dynamism. And the fact is that the U.S. just isn't as robust as it wasn't in that position, that we have lower productivity that we've had. We certainly have, we're being impacted by these demographic changes and labor shortages. So there's a lot of moving levers that we have to solve this, which brings us, and we want to bring this back to what the media has been calling, table conversations, breakfast conversations. And those are the things that are keeping many of our, the U.S., people around the world, but we're talking mostly in the U.S. here, men and women awake at night. Jobs, what's the future of jobs, wages, interest rates, recession. So I'm going to throw this out to you, Matt, to start, and then we'll bring it back to Dick, and then also want to hear what John has to say, because John, you talk to a lot of people, and you've also have a lot of experience in this area as well. So Matt, I mean, there's a lot there. We got jobs, we got wage growth, which seems to be slowing a little bit, but it's not keeping up. We've got, we're unsure of where interest rates are headed. What's your take on where we are now and where we're headed?
Well, it's a interesting time to be alive, like always. Never before, to my knowledge, has the Federal Reserve increased interest rates to the extent they've done it without tripping a recession. Furthermore, you've never seen, this morning you had the inverted yield curve. I believe it's close to 100 basis points right now. You've I think only once in history have you seen an inverted yield curve without a recession the following 18 to 24 months. But when you get to 100 basis points, which is 1%, which is basically what you're saying is, I would rather lend for short term than long term, because I think there's going to be a recession. That's what the Treasury market is pricing in, is there's a big recession coming. And usually when the Treasury market prices that in, it usually happens. And then you go and you listen to the Federal Reserve board members go out and speak, and there's hardly one of them that's not trying to be more hawkish than the next one, which is, we're going to do this until we've killed inflation. And the only way they can kill inflation is by killing demand. And the only way they can kill demand is by killing the job market. So what you have, everyone on all cylinders telling you, is a recession is coming. The market is telling you that. The Federal Reserve is telling you they're trying to cause one. They're trying to cause a job recession. As much as there's, tacit speak to softish landings, and maybe we'll get this one right, and hopefully we won't be out there, and the politicians are out there being pretty optimistic that, unemployment at 3.5% that's nothing to laugh at. I mean, that's a really, really healthy economy. And at the same time, you have the Fed talking about killing it. So it's really interesting, because, the old traditional definition of a recession is when your neighbor loses a job, and when it's depression, it's when you lose your job. But no one's losing their jobs right now. And not only is no one losing their jobs, but I don't know if anyone's been to a restaurant lately. It's hard to get a seat. Go to the airport. The lines are insane. Go to Disneyland. You can't get in unless you're willing to spend $1,000 for a family of 4. Go to the movies. It's sold out. Go anywhere. It's bonkers out there. It is. People are spending like there's no tomorrow, and the interest rate increases as well. While it's clearly dampening mortgage refinancing and new home sales, it hasn't really dropped home prices. There's not a place in our economy where you could look to and say, oh, clearly there is weakness there. But it's coming. It's priced in. The policymakers are telling you to expect it. The market is telling you to expect it, that we're on the verge of a big recession. So is this the first time in history that it doesn't happen? Maybe. Maybe we get lucky. Maybe they do have the softest landing. But if you are a student of history, everything's telling you to get ready for a big recession, batten down the hatches, and be prepared.
I guess one of my, this isn't even a rebuttal, just a comment going through my head, is that we are living in these never normal times. And just as you said, Matt, is this the first time in history that happens? And, even going back through recessions, and we've talked about this before, there's been 12 recessions since 1945. And in all of them, the lowest unemployment rate was 6%. But what happened? It seems like we're defying that trend, that movement right now. Dick, what are your thoughts on that? I mean, we just had some of the numbers come out where we still have low unemployment. The JOLTS rate, that the people are quitting a little less than they did last year, but it's still over 4 million. We're still 1.5 million more people quit every month than they did, prior to the pandemic. Where do you see things heading?
Well, I mean, I obviously agree with Matt that, we are headed for a recession. But, I have been trying very hard over the last year to figure out how to position oneself in the economy as we go to and through what might be a recession. And I've come to the conclusion that, we are moving from an old cycle, the old cycle being dominated by consumption and, if you will, this high-tech use of consumption. But we're moving to a new economy, which is going to be based, I believe, on production, manufacturing, on, natural resources, on, defense, on food. In other words, I think we're moving away from worrying about whether Apple is going to make the best, earphones ever known to mankind, and thinking about how do we get gas at a reasonable price in our cars? How do we get heating in our home at a reasonable price? How do we get, the ability to sell products worldwide? And I think the stock market has picked up on this issue also, because if you noticed in 2022, defense stocks actually were up. They weren't beating the market. They were up. They were not down. The same is true of energy stocks and some of the natural resource plays. Manufacturing was not up as much as manufacturing was down. It was not down as much as the market. But if you compare manufacturing to what I'll call these consumer tech stocks, the consumer tech stocks were down double the decline that occurred in manufacturing. So I think what I prefer to do is kind of concentrate on where we're going. And I'm absolutely convinced that that's the direction we're going in. Manufacturing, natural resources, food, energy, defense. And I think the banks, will fund that. So I think there are real opportunities developing in the areas we're moving toward. And I just can't stand listening to another Fed speaker. I just don't want to hear anymore about, what's going to happen, in the recession. What I want to know about is how do I position myself for the future? And I think we're on the right track. And I think the market is coming to that point of view, and that it'll be on the same track. So I think this is the way we're going to make money. This is the way we're not going to make money, and therefore start thinking about the way we're going to make money.
And John, I want to loop you in here on the heels of that, thinking about in quarter three, we had record corporate profits, right, in the United States. And so to hear that kind of juxtaposed against, it's likely that we're going to hit a recession in 2023. How do we kind of make sense of that, John, in terms of we've got record corporate profits going on against lackluster wage growth and then 40-year high inflation? What are you seeing and hearing from additional people as well in regard to what things are looking like for 2023?
Yeah, thanks, Jason. I just want to quickly go back to what Dick and Matt had been saying about this pending recession. Everybody is talking about a recession coming, and the question is, will it be a job-full recession? That's a theme that you have spoken about in the past, Ira. I mean, the labor numbers, the number of workers coming into the labor markets are, completely, strikingly lower than they were a generation or two ago. And that, again, of course, speaks to this whole demographic crisis, the drop in fertility rates across the globe. So that's maybe why we just haven't seen the unemployment numbers tick up. But to that question, Jason, I mean, it's a striking number, in the non-financial sector, the record corporate profits. And then there's been this sort of political rhetoric about, wage growth not keeping up with those kind of numbers. I mean, I think we have to kind of sometimes separate the political rhetoric from the reality, on the ground. And this is something Dick could pick up on. I mean, you clearly have to define what price gouging might be, if that's what some of the critics are saying, that there's these excess corporate profits. And then the other question is, of course, that there has been some wage growth, and interestingly, as a footnote and a side note to all of that, is that we're seeing, for the first time in a generation or so, a rise in more labor movement activism. So we'll see how that plays out over the next year or so. We saw how the nurses in New York City settled in the past 24 hours. And again, a lot of this is just one of those byproducts of inflation, the social chaos that it reaps. But Dick might be able to address that on the corporate profit side, because he's done a lot of research on productivity, labor, and inflation. And I think that addresses much of that.
Well, okay. Well, if you want me to talk about the profitability issue, it's really a complex issue in the sense that if there's been a significant increase in the sale of units, then the fixed cost per unit sold is going down. And therefore, even without price control on the part of the seller of the products, margins for corporations would go up, right? In other words, their margins would expand simply because there's less fixed cost per unit of product sold. At the same point in time, I do think that there has been some price gouging, in multiple industries, because, consumers have money, they have jobs, they seem to be spending. I mean, credit card debt rose 16% year over year, in 2022. So the consumer is out spending, and if you took it at non-securitized debt, on the part of the consumer, that's up by 12%. So the net effect is, if the consumer is going to buy everything, corporations get, pricing power. So you have two factors here leading toward, increased margins. You have, pricing power on the part of corporations, which they're utilizing to their benefit, and you have the fact that unit sales are increasing, which is dropping, the fixed cost per unit sold, which also leads to margin improvement. So I think that the margin improvement issue is somewhat complex and needs a heck of a lot more study than I just threw out at you right now. But I do think that in the recession there will be less pricing power on the part of companies, and therefore that will allow inflation to come down, and it will hit the margins of corporations.
I just want to pipe in on this phrase, price gouging. The reality is price gouging is, there is a definition. It's usually taking advantage of temporary dislocations. Usually it's with natural disasters or in areas where there's temporary shortages due to extreme circumstances, that almost, godlike circumstances that create the price gouging. What you have right now is companies making the decision, somewhat of their own accord, to maximize their profits. And what you're trying to do as a business is maximize their profits. And one reason businesses choose not to go ahead and maximize their profits when they maybe could is because when you increase your cost of goods, you invite competition. And what you have right now, because of labor shortages, because of supply chain disruptions, is companies can raise their prices to maximize their profits without threat that competition is going to come in and undercut them because there's not real replacement opportunity. But that's different than price gouging. This is what drives an economy. A healthy economy allows for competition. A healthy economy rewards companies that create something that creates demand, and then they price the demand where demand meets supply, and that's where you get price. It's a pretty basic function of the economy. And right now, what we have, I would argue, it's largely because of government intervention in a free economy, is you have supply shortages and supply chain shortages, and a government that would step back and let the system work instead of trying to go product by product and impose tariffs or go down to the Three Amigos convention in Mexico City and talk about how we're going to roll back the NAFTA free trade protections to try to become more protectionist. It's ridiculous. And one of the things that came out of the IRA, they call it the Inflation Reduction Act, which is absurd because there's nothing about it that has anything to do with inflation except increasing it, is you have all these rewards. One example that keeps coming up is these rewards if you're an electric car manufacturer. And everyone can have an opinion about what they think about encouraging electric car manufacturing. Great, your opinion is probably wrong, so is mine. But the idea is, if you look at it, they're rewarding certain car manufacturers that have to meet a litany of just inflationary checklists. You have to be unionized. You have to have prevailing wage unionization. It has to be manufactured in the United States. It eliminates, I believe Tesla is not eligible for any of this stuff. So you're not out there saying, hey, we want to grow electric car manufacturing, because if that was what you wanted to waste your taxpayer dollars doing, you would waste your taxpayer dollars being neutral to which electric cars get produced. But they're not being neutral. They're saying we want unionized cars manufactured in the United States from manufactured supplies that are also manufactured in the United States, that also are based on raw materials that also come from the United States. It's basically a new fancy form of protectionism, which is actually massively inflationary. So I think this phrase price gouging is really more of it's just inflation. There's more demand than there is supply, and prices go up straight up, not price gouging due to an act of God or some sort of natural disaster type event.
Yesterday we had the opportunity to interview Gad Levinan, chief economist. Used to be with the Conference Board, now he's with the Burning Glass Institute, and he talked. He quoted someone, which was totally unexpected, the Joker from Batman, in describing where we are. And Matt, as you were just going through that just resonated with me, that we're having a collision of a unstoppable force with an immovable object. And so we're left with certain levers we can pull, certain things we can do. And we've talked about all, what the Fed is doing, and they're trying to regulate. One of the levers they have is with interest rates. What are some of the things that our listeners can do as in business to help, I guess, survive or grow and thrive, which would be ideal when an unstoppable force hits an immovable object?
Well, I might just quickly come in here and set this up for Dick, but in some of his most recent research, he was just talking about the geopolitical trends and how it's impacting the domestic economy on reshoring. I mean, there's been a lot of analysis and studies on this lately that American CEOs are talking about bringing jobs back to America on American soil, and it's going to create, by extension, a lot of investment opportunities.
Yeah, and it seems, and just to comment on that, just delivered. I mean, it seems like the semiconductor bill that we had was certainly certainly one effort to be able to do that.
Well, I think that it's clear. I don't like to be thought of as an isolationist, but I understand and have read all of the economists who argue that the free flow of goods to areas of lowest cost in producing those goods, is good for the world economy, and it's good for consumers in every nation. But China did not become the second largest economy in the world because it followed that practice, right? And Japan, prior to China, did not rise from its position, nor did Germany, because they followed those particular economic rules. Those countries did the exact opposite. Germany to the lesser degree, but Japan and China both got their positions in the world because they flouted all of the rules, that free movement of goods and free movement of money would argue. And I think that the United States is suffering because of it. We lost 70,000 factories in the United States, according to a recent study that was published in Foreign Affairs magazine. We lost 5 million jobs. We were the number one steel producer in the world. We're now number 20. We were number one in aluminum. We're now number 9. We have no position of meaningful size in rare earths. We have lost, any opportunity to become a dominant factor in the lithium market. China has grabbed both of those things. So, my belief is that, we have no choice, but we've got to go back to a kind of an isolationist, economy in order to allow these businesses to grow in the United States. Now, they will ultimately only grow if we can produce products which are lowest cost and highest in utility, to people around the world. And I think that the job of technology, as I said, is not to come up with, a better way of doing consumer tech, but is to get ways to make manufacturing in this country effective. But I think manufacturing in this country must be protected. I think we must get a very stronger position in lithium and rare earths and rhodium and all of these other things that are necessary for the economy of the future. But it's not going to happen if we adopt the view that, free flow of goods and free flow of money is beneficial to everyone. Because again, I don't think China ever used free flow of goods or free flow of money to get to the position that they're in right now. I do not believe Japan did that before them. And therefore, even though the economists in theory might be right, in practice, we're just not seeing that in the real world.
And Dick, with that, recently I saw some startling statistics on the future of jobs in the economy, and that there's emerging research suggesting by the time we get to 2030, that roughly 85% of the jobs that will be around in 2030 are jobs that don't even exist yet. That's how rapid the type of jobs and the type of work is going to be in the new economy. Have you come across any of that in terms of what are going to be some of those new types of jobs that emerge over the next 7 years? And then number 2 with that would be, how do we upskill and get folks ready for that, for the types of skills that they may need in this new economy for those types of jobs?
Well, unfortunately, I do not know what the jobs of the future are going to be. But what I am seeing is this massive shift in the use of workers in the United States at the present time. If I said a short time ago that, at the end of World War II, 50% of the workers were involved in producing and sending goods. Well, today, 50% of the workers, or slightly under that, are involved in healthcare, education, and in, management of companies and financial systems. So the net effect is we've moved so far away from being the leader in the creation of these jobs in the future that it's staggering, and that's what I'm kind of pointing to. We have got to redirect the technology in the United States, toward basically creating the ability of generating products which are worldwide competitive because they're low in price and they're high in utility. And I don't see us doing it. And that's that. I'm not answering your question, Jason, so I apologize because I don't know the answer to your question. But I am extremely worried that wherever these new jobs show up, they're not going to be here because essentially, China is ahead of us in telecommunications. Russia and China are ahead of us in defense technology. And essentially, if all we're going to do is focus on consumption and systems, to lay out money as a result of getting it from the government, we're not going to get to be the producer of those jobs of the future, because we have not been the producer of those jobs in the past 5 years. We've moved more and more to a consumption-driven economy, which is hurting us. And I apologize. One thought to put in your mind. I recently took a look at the U.S. government changed all its statistics in 2002, so they gave a raft of new information. What I noticed was that if you took the growth in real GDP from 2002 to 2022, it was 1.9%. 1.9%. If you took the growth in the Federal Reserve balance sheet from 2002 to 2022, it was 11%. It was 6 times greater. So because we want to consume and we don't want to produce, we are borrowing the money to get the money to consume, and the borrowing is created this monster called the Federal Reserve, which is now got $1.1 trillion in liabilities above their assets, and we can't let that continue. So I apologize, I have not answered your question, but my fear is that we are so sunk into consumerism and borrowing money to make consumerism work, and getting a Federal Reserve to just keep doing the Greenspan put, the Bernanke put, the Yellen put, the Powell put, that we essentially have lost direction altogether, and we can't continue to do that.
I will counter a little bit of what Dick's saying. I love when I go against Dick, because it makes me feel good, because he's usually right and I usually agree with him. But when you sit there and say, oh, Russia and China have better military technology than us, like, come on, what planet are you on? They might be spending a greater share of their GDP as part Russia, maybe because of the war, but China, we have 11 aircraft carriers. They have 1. We have 11 that can go at what's called Blue Sea, more than 200 miles from their shore. They have 0. We have 100% of our submarine fleet is nuclear and silent and goes around the ocean without almost anyone knowing that they're there. They have a diesel fleet, and I think they're working on their first nuclear sub. And then put Russia in the mix. They're nowhere close to us. What they have is they have one technology that can wipe out the planet Earth. They have the doomsday bomb, and that's scary because they could do it, but they don't have actual on the ground weaponization that is giving them some sort of advantage over some backwater Eastern European country like Ukraine. They're losing as much as they are winning, and they have more territory. They were supposed to take Kyiv in 3 days, and they're sitting there fighting in the trenches in the Eastern Ukraine, basically where they were in 2014. In terms of where the jobs are going to come, well, look at what Elon Musk did with Twitter. He showed up. He put out a really nasty memo saying, we want you to be really committed to our company, otherwise go find work elsewhere. And 75 to 80% of his workforce left. And most Twitter users think it's a better product today. And he automatically overnight increased productivity by 5x. Like, there's a lot of slack in the American system that can work. And in terms of that can work better. In terms of reshoring, I think you're 100% right. Where I would disagree is, it seems to me that America does things really well, certain things. It's the very, very low end of stuff where it has to be done here, like, laundry. You have to get your car washes. You have to fill up your gas station. You have to go to the gas station. You have to go to the grocery store. There's no way you can offshore that stuff. The Walmart store has to be in your neighborhood. Like, that has to be here. So America is really good at efficient consumerism stuff. The other place where America is really good is, when was the last time you bought a phone that was designed by a non-American? When was the last time you used a computer that wasn't American software? When was the last time you got an MRI that wasn't designed by an American company? When was the last time you flew on a plane that wasn't designed in the Western world? When was the last time you did anything of super high tech that wasn't American? You don't. America is really strong at the very, very high end of manufacturing, design, innovation. And where we outsource, or historically have outsourced, is in the commoditization of clothing manufacturing, plastics that have to be built for the iPhones, the glass screens where you can go and find the cheapest labor. And the only reason it's cheaper is because the labor's cheaper. And when you add on the shipping and the tariffs and the hassle of the language and offshoring and all that, it's a lot cheaper to do it. But what COVID showed us was, you're actually creating leverage in your supply chain. You're becoming super dependent, And there is a time when you're saving, 70, 80% of your costs by going offshore, that it doesn't matter how much the rest of the hassle creates, it's worth it. But when you start getting down to the 5, 10, 15% savings, but you still have to deal with all that hassle, well, that's when you come back to onshoring. And this is where I get kind of worried about the Three Amigos meeting down in Mexico. The best way to onshore, if you're an American company, is to do it in Mexico, where they have labor costs that are basically 1/10, but you don't have any tariffs, you don't have any cross-border issues. And America definitely needs NAFTA more than NAFTA needs America, in my mind. And as long as you have the North American market consolidated, companies are going to go where it's best for them. And I think right now you're totally right that the trend is coming back. And what the jobs are going to look like is it's going to be, the same way a McDonald's used to have 30 people cooking the hamburgers, cooking the fries, someone there with a timer and a stopwatch. Now it's just one button, cook the fries. There's another guy that cooks the burgers. And, McDonald's, I think there's a stat that they've dropped on average 50% of their workforce from the average store over 30 years ago due to automation. But that hasn't led to a plethora of unemployment throughout the United States. It's led to massive employment. It lets people work in industries where they're best suited and best fit. And so I think the future of America is bright, largely because of immigration, largely because, you talk about America's population decline, which you're 100% right on. It's a problem. But we have this great asset that no other country on earth has, is we have a flood of people trying to come here, and they're usually young people. And to the degree they're young people with kids and families. And so you look across the world, Europe has the same demographic problem. China has the demographic problem. Japan has it in spades. But none of those countries have immigration as a solution. So I am very bullish on America. And I also think that the opportunities for jobs throughout the manufacturing cycle are going to be strong here. And I agree, it would be great if we had leaders. We don't. It'd be great if we had a Congress. We don't. It'd be great if we had a president that cared. We don't. But we have natural advantages being on a continent surrounded by oceans, nowhere near our enemies, and a demography and immigration that allows us to rise above all the challenges we have, which is including the lack of leadership in the government.
Matt points out something which I think is the nub of the problem. In other words, and by the way, I understand we have the strongest defense in the world, but we don't have hypersonic missiles. And those hypersonic missiles means that we don't have oceans separating us against, China or Russia. And, the Russians can put up a hypersonic missile with 15 nuclear warheads on it, and it can shoot that missile up, and we can't stop it, number one. And number two, those 15 warheads can go to 15 cities. So one missile can wipe out 15 cities in the United States, and we don't have anything to prevent it. So they have leaped ahead of us in certain defense technologies. But what Matt is describing is in the early 1990s, when the Soviet Union fell apart, it became possible to manufacture goods anywhere you wanted in the world. It became possible to get money anywhere you wanted it, and to any place you wanted it in the world. So the net effect is we came with this new business model, and this new business model basically says we will design the product, and then we will ship the designs to the Southeast Asians who will produce that product, and then they will ship the product back to us and we will sell it. And that's exactly what's happened for the last 30 years. So the net effect of it is we have lower cost products, right? But the same result of doing that, and we did it because, by the way, we had the cheap labor, number one, but number two, we also did not have to make the capital expenditures in the factories, and therefore the cyclical swings in our economy would be less than the cyclical swings in those economies where the factories existed. So that was the second benefit we got. And the third benefit was we could take the cash that we're not using for, manufacturing these products and building these factories and buy back stock. So the result of that was certainly we have lower cost products. However, they now do have technological leads on us in certain critical sectors. They got the rare earths, we don't. They got the lithium, we don't. They got the improved telecommunications systems, we don't. So it's not that we are on the front edge of these technological breakthroughs. In many cases we are not. And if you take a look at, an example of using that capability, Apple, has wonderful designs for iPhones, but they don't make them here. They make them in China. And instead of wanting to move, them out of China to the United States, they want to move them out of China to India. So Tesla, is building its, cars, increasingly in China, and that's the problem. The problem is when you do that, then the workers in the United States do work at McDonald's. They do work as bellboys at hotels. They're not working in manufacturing. Therefore, the gap in income spreads dramatically. In other words, the Gini index for the United States is one of the worst in the world in terms of income inequality. And it's because we're in consumer occupations, we're not in production occupations. So yes, that's way the things, Matt's description is the way things went from 1990 to 2020. I don't think that's the way it's going to be from 2020 to 2050.
But you don't see the benefit in the fact that we don't have to pay $3,000 for our phones, because that's the estimated cost Tim Cook apparently told Donald Trump when Donald Trump was twisting his arm saying, hey, why don't you build your phones here? And he said, well, it costs $3,000 to sell the phones here. The entire,
I think that's all profit margin, but that's
maybe, but the entire society is benefiting from optimization of resources. We all benefit by having cheaper products and leaves more money in our wallet for other things by being able to outsource that which we can't do as effectively as other countries. It's basic economics to outsource low value production. So,
well, I'm going to come in here, Matt. I'm on the side of Dick on this largely. I mean, there's a huge social and economic cost of what we've been doing for the past generation or two with all this outsourcing. We've hollowed out a lot of these communities throughout the Midwest. There's a social and an economic cost, and we do have to create higher value jobs that pay very well. But it raises another question, which gets back to the demographics. We don't have enough people entering the labor force on an annual basis. We're down to 500,000 a year, I think it is, from 2.5 million, a generation or so ago. And it also raises an additional question. We don't have the skill sets, and we don't have sensible immigration policies. And we also probably, complementing all of that, we need a proper education system to provide those kind of skills and technology so that, the workers will be able to do all these kind of high-end kind of jobs that America's going to need to grow its economy and raise the standard of living. And, when you raise the growth levels of the economy, then you can start talking about paying down debt. That's a problem. We've 1.9% growth or something Dick mentioned there earlier. We're just not growing fast enough, is why we have all this debt as well.
Well, Paul, let me jump in with a simple example. Take a car ride through Gary, Indiana, and take a car ride through Beverly Hills. The person in Beverly Hills gets to buy that iPhone, at a slightly lower price. The person in Gary, Indiana, doesn't have food, doesn't have a job, doesn't have a factory. I've never seen so many broken down buildings anywhere in my life than driving through Gary, Indiana. And that's the result of outsourcing everything to the high quality jobs to places outside the United States. Gary, Indiana. That's the result. If that's what we want, because we want the person in Beverly Hills to pay a little bit less for their iPhone, I'm not on board with that.
One of the things that I think that we've come to a conclusion this morning is that the problem is incredibly complex. And even with some of the smartest people I know, we have lots of different opinions, and every conversation seems to open up a few more doors of reasons why it's complicated. So we can continue on this for a long time, and appreciate everybody being here. But there's one thing that we did want to bring up, and it's a little bit of a misdirect on this. And we just touched on it last time because it just started to happen. Basically, it's FTX, the crypto collapse. John, I want to push this to you, and be able to bring in Dick and Matt. Because there's a lot of controversy here, what the challenges are. But back in your day, you were, I don't know if I can't remember if you were an editor of Traders Magazine or were you just writing for Traders Magazine, but you had a legendary cover story. You interviewed Bernie Madoff in his heyday, And again, I guess we can't help but ask, are there similarities between what you saw happening with Bernie Madoff and his collapse with Sam Bankman-Fried and the FTX collapse?
Well, first of all, Ira, don't demote me. I was the editor at Traders Magazine.
Okay.
It was a very distinguished and august publication and just produced great stuff on the institutional trading markets. It was a very fun time. Bernie was an enigmatic and strange and solitary figure. We know all that. If there's one, I mean, you want, a sharp and striking difference. Bernie never wore hoodies. I think Sam was always pictured wearing those hoodies. Bernie was the quintessential Wall Street toff in a sense, always elegantly and immaculately dressed. I mean, but they came from two different backgrounds. Bernie was your classic, in many sense, Queens blue-collar guy who grew up working class. His family had many misfortunes financially through their lives. So I guess that drove Bernie to succeed. He was quite a sharp-minded individual, if we can believe what we read, whereas Sam was raised in a liberal upper middle-class family on the West Coast by two college professor parents. I mean, people have referred to Sam as the sort of the mini Bernie because of the scale of the losses that were reported. I think 8 billion, whereas Bernie's was something in the region of 65 billion. And I guess adjusted for inflation, those losses now would be a lot higher than the 65. But what would be worth watching in terms of the current disaster and fraud that's been reported on the Sam Bankman-Fried side is the recovery of those losses. Where will that head? I mean, we're all in the last 24 hours, 48 hours, we've heard that they may have come up at 5 billion already that, may be recovered, but we'll see where that goes to those unfortunate clients who lost that money. And in terms of Bernie, the numbers I've seen over the years are pretty striking. I mean, the claims, 80 to 90% or more of the claims were settled with clients, which is not to excuse, the deeds and the fraud and the Ponzi scheme that Bernie did and what Sam has been accused of. Sam's, in a sense, was, as far as we know, a Ponzi scheme. But it raises the whole question of crypto. Sam dealt in cryptocurrencies. Bernie, took real cash from a lot of people who should have known better. Maybe they did know better, but they were unsuspecting in many cases. But it raised the whole issue of crypto being, in the center of this whole drama at the moment. And it's something we've looked at in Odeon Capital Conversations, and Dick and Matt have spoken about and have, I'm sure, opinions about.
I'm never one to want to talk about someone's criminality, but to the extent that, obviously innocent until proven guilty for Mr. Sam Bankman-Fried. But let's be clear. This is a guy, Bernie Madoff, who, by and large, from what I understand, his clients were super, super high net worth. And to the extent they're in his country club, there's all these stories about people coming up to him and trying to invest in him, being like, no, let's keep our friendship. And he would waive his, he was really hard to invest with. And I'm not trying to psychoanalyze as much as that's exactly what I'm doing. But it seemed to me that Bernie had some sort of degree of, like, he knew he was a fraud. He knew he was a Ponzi scheme, and he was trying to protect those closest to him from making the mistake of investing with him. And John's right. I think the total recovery on the estate was around 85 cents because at the end of the day, he was a classic Ponzi scheme, and you can unwind a Ponzi scheme if you can follow the money. What Sam was doing was he was advertising on the Super Bowl. He was buying stadiums. He's going out after retail. He was pitching himself as an alternative to your FDIC insured bank. Give me your $100. Give me your $150. Boldness favors the brave. Like, he was trying to be a Ponzi scheme to the entire world for every dollar of pocket change that you could get. And, to the extent that there's a difference, it sure seems like Sam doesn't know maybe that he was a Ponzi schemer, because he seems to be out there. Even this morning, he published a Substack talking about how he's innocent. It was all just it's a normal. He had a traditionally sophisticated business that just happened to fail. And it's like, what are you talking about, man? Your entire balance sheet was these fake tokens that you invented. You sold one of them to yourself for $100, and then you said, "Oh, I've got this $100 billion balance sheet." Well, just because you create a billion tokens, sell one for $100, doesn't mean you have $100 billion in the bank. And he doesn't seem to understand that. So it's kind of weird to me that they're compared, because Bernie was a traditional Ponzi schemer. His sons accused him. He confessed immediately. He knew exactly what he was doing. Whereas Sam seems to be deluded by this idea that somehow he's legit.
Yeah, no, you're absolutely right there, Matt. It seems to be living in some kind of alternative universe. I think in the case of Bernie, I've always felt that Bernie felt he was going to get away ultimately with his scheme. He was going to somehow re-engineer his way out of it. I mean, what brought him down, obviously, was the 2008 subprime crisis. And so he couldn't make his investors good on withdrawals. But the other question is, the SEC and the regulators took so long to catch up with Bernie. And I think they might have been slow to catch up in the beginning, at least with Sam.
Yeah, I mean, the difference is Bernie hid himself within proper regulatory regimes. I mean, I think he was one of the co-founders of some of the NASDAQ, and he was on the boards of a lot of mainstream Wall Street entities. And he was so legit that when he had a whistleblower come after him and write exactly in a detailed format, this is how this guy's running his Ponzi scheme, the SEC looked at it and was like, doesn't look like a Ponzi scheme to us on the surface. We're not going to scratch too hard. Whereas Sam Bankman-Fried, all it took was one pushing of that first domino, and then all of a sudden you see his balance sheet, and then all of a sudden you see the due diligence Sequoia did, and you're like, wait, this is a company that has all red flags. There's not white flags at all. There's no area of that company where you're like, well, at least they have good compliance, or at least they have a checking account. No, they did not have a checking account. They were laundering their money through their Alameda research account. Like they didn't even have a checking account. Like, how do you invest in a company and you don't have a checking account in your own name and you're a legitimate company? I mean, it to me, this is much more just the hype. He caught a wave. He rode the wave all the way to shore. And as Warren Buffett says, when the tide goes out, you see who's naked. And it turns out this guy was entirely naked, and everyone around him was too, and the entire industry and every boat that's attached to it and everyone before and after him. I think DCG is probably on the ropes. It sure looks like the Winklevi, their group, is on the ropes. It sure looks like Binance. If you're to swap out the name Binance and FTX, you couldn't tell a difference between the articles because they're exactly the same. We have a very healthy balance sheet full of stuff. We're not going to tell you what it is because that would ruin our secret sauce, but we're very rich. Trust us.
Yeah, I mean,
on the other side of the Oh, sorry. Go ahead,
I'm just
John.
going to say that Bernie, of course, was the go-to guy in Washington. He ingratiated himself with regulators, lawmakers, even celebrities on some level. They had some kind of naming rights at Met Stadium, at Citi Field. It's called Citi Field now. It was Shea Stadium back then. And Sam did the same thing. He had all these, surrounded by all these celebrities, and he had all the allure and the attraction of success and people. Both of them were magnets and enigmatic in a very strange and bizarre way.
Dick, you've been uncustomarily quiet about this.
Well, I'm kind of jealous of Bankman-Fried, because when my grandson, and John knows this, when my grandson and a couple of his buddies, were playing this, video game called cryptocurrencies, they created their own cryptocurrency, and they made, a few $1,000 a piece, but that's all. This guy made hundreds of millions of dollars, right? But I do own cryptocurrencies, which I always have to admit, and I don't believe that they have found a useful function yet. I think that they're trying hard to find that useful function in terms of the delivery of funds, rapidly, without disclosure. But I think that basically they are still an investment game, and I still think it's being done by young people playing video games, which is called the cryptocurrency market, using the Japanese candlestick method of trading them. I don't think that as a result of what just happened, that a bunch of kids like my grandson and his buddies can create their own cryptocurrency and then walk away with a few $1,000 and go buy. One kid bought himself a car and was very happy with the whole system. I think that era is now over, and that all the talk about regulating this industry, which has been nothing but talk since nobody's ever done anything, I think will kind of crystallize, and we'll start to get some regulation to where cryptocurrencies now start to have some base, at least in being monitored for a whole bunch of reasons. But I mean, again, the bottom line is that essentially, I think there is going to be an opportunity in cryptocurrency beyond just a speculative mechanism. But I own it for that reason. But I don't have any faith in them at the moment.
Yeah, with that, Dick, I think the exciting thing is many times, we talk interchangeably about crypto and blockchain, but they're actually two different things. Cryptos are the tokens that are used for the utilization of apps that sit on blockchains. Right. And just this week, it was announced Avalanche, which is a layer 1 blockchain company, has entered into an agreement with Amazon Web Services, because Amazon now understands the future of a lot of their deployment, the way that their technology is going to be used on the blockchain. And so going back to some things you shared earlier about, the importance of manufacturing, the types of jobs, the types of skills that we're going to have, we do have some bad players out there like Sam Bankman-Fried who are doing things the wrong way. But on the other side of the token, I do think the blockchain is starting to work with some of these top technology companies that we have that are trying to start to move their infrastructure towards blockchain more, because they see the benefits that it's going to have in the future. And I do think that's going to be an exciting development for us from an economical standpoint. There's a lot of developers I know in the space that are moving from working for traditional software development companies. They're getting on board to take their talent, skills, and innovation with blockchain companies that are starting to become well established. So I think that's another positive sign of things to come in the years ahead for the economy, is the way that blockchain is going to be used and change our lives.
We unfortunately and very sadly need to bring this to conclusion. There's a lot more topics that we didn't get to, and hopefully we'll be able to get you guys back again. It's always a wealth of information and enjoy, and the time goes by incredibly fast. But we like to close each of our episodes with the question, and the one that I want to present to each of you, because there's so much that we didn't cover. And we'll start with where we began. We'll start with you, Dick. Was there something that you wanted us to ask that we didn't?
Yeah, I am really fascinated by the fact that the Federal Reserve has got negative equity of 1.1 trillion and is funding itself in the short-term money markets, as opposed to the traditional method of printing money. And I think that is a total disaster happening, and a critical issue that has to be looked at, and that is a subject that we didn't discuss, but is really close to my heart and my mind at the moment.
So we're going to put that down, and hopefully that's a reason to come back and join us again and explore that, and it'll give you a couple of weeks to prepare.
Okay.
Hey, Matt, what?
I mean, I would say the question I think that I keep thinking about is, what is the greatest threat to the global economy? And to me, I think a lot of people, but not necessarily mainstream people, are looking at Japan and what they're doing with their yield curve. And they are holders of like 1.3 trillion, I think, U.S. treasuries. And if they actually have to repatriate dollars in order to finance government positions to control their currency, it could really cause a hiccup in what the Fed is trying to do, and it could force QE faster than they think. And I think that's something that's on my radar that I'm looking for to be a negative indicator that the economy is about to go off the rails.
John?
Yeah. By the way, the cover story I wrote for Traders Magazine, my interview with Bernie and Peter and the others, was the Madoff mystery, which was kind of prophetic. It was a few years prior to the collapse. Immigration reform, how we can have sensible immigration, bring people in with technology skills, vocational skills, intellectual skills. The system in America is totally broken, and we need to start addressing it and get it right this time.
Jason?
I think probably the end there, blockchain. I love the applications of what blockchain I think is going to bring in terms of innovation to so many industries. Richard Foster has often said by the time we get to 2028, somewhere around 40% of the Fortune 500 companies may no longer exist, or at least exist in the way that we know them today. So as scary as things are, and we probably are headed toward a recession based on our expertise that we heard here today, I do think that it's going to be an evolutionary step into things that'll be even better down the road for us in terms of the types of jobs that we'll be able to create, and the types of things that technology will be able to help us, just as we go through some of these, these difficult steps in the short term of getting there.
And it looks like it's time to wrap up. So I'm Ira Wolfe. Special thanks to Dick Bove, Mat Van Alstyne, John Aidan Byrne for spending some time with us again. Definitely, if you want to hear more about this, you can hear about it weekly on the Odeon Capital Conversations podcast. Please check it out. And while you're there, while you're on listening to your podcast, check out Dig Life Deep. And you can listen to my segment. Excellent interviews with John Aidan Byrne every week, which are not always based on financial, but a lot of provocative topics and interesting topics. But you can also hear my segment, Future Shock 2.0. I want to thank everybody again for being part of Googleization Nation. Thank you again, everyone, for being here. And until next time, don't let the shift hit your plans.